A lot of professionals end up in that boat where they're like so good at risk management, they're not earning enough. And it doesn't justify all the work you put in. And then you have to get more aggressive. So there's this sweet spot, this middle ground where you're aggressive, you're willing to take, I don't know, I think for me, somewhere between 20 and 30% peak to valley drawdowns in equity in a really bad situation in order to make somewhere between 30 and, amazing, knock the cover off the ball type of year, 100% or slightly above, triple digit income.
Just a quick pause before we get into this. Trading can be intense, and staying mindful during your session matters so much. That's why I created and am sharing a free 3-part audio experience that's helped me deeply. 1, for starting your day with calm intention. 1, to stay centered while you trade. And 1, to wind down with grace when it's time to stop. These tracks are yours. Just click the link in the description. Hey, welcome back. Here at the Market Mamas podcast, I cover a wide range of topics from the intricacies of day trading to mindset mastery and psychological growth, with the goal of the conversations being next level growth for all of us. My name is Becky, and I'm a US-based futures day trader from the Pacific Northwest. My trading experience includes trading stocks, options, crypto, and futures, with both trading a personal account as well as with prop funding companies. Over time, I found that I most enjoy the fast-paced world of intraday futures trading, so that is my primary day trading focus now. Thank you for joining me on the Market Mamas podcast today. Hey guys, so Market Mamas podcast, and it's my pleasure to bring on another guest today, and someone who has been in this industry far longer than me, and I really value learning from those who have been doing a thing longer than I have and have so much more wisdom than I have yet to gain in my time in this industry. So I am very pleased to welcome as my guest today, Richard Weissman, and we're going to learn all about his career and how he has grown and evolved in the world of trading. So thank you so much for being with me, Richard.
Thank you, Becky. Appreciate it.
Yeah. So I started trading in 2021. You were a little bit before that, right?
Yeah, I started in 87 in January, so before the stock market crashed.
Right. Oh my gosh, what a pivotal time in the industry recently in the last 50 years. Wow.
Yeah. So I like to say it was the first time I ever saw grown men crying over money.
Weeping.
Yeah. It was amazing. Yeah. And it really taught me risk management from early on, that I didn't want to bet so big that I lost everything.
Fortunes were lost, like a lot of fortunes.
Yeah. And it also, so that was the first thing, was to control the risk. The other thing that I learned from it, you could have the whole structure come down, and it was all very fragile, much more fragile than we imagine it to be. And I think that it created a bias in me that I always was afraid of the bear side and afraid of crashes, which is not so great if you consider that the stock market, went from 800 on the Dow or 1,000 on the Dow or 2,700. Yeah, so it went to around 2,700 was the high, right? And then it crashed down to like 1,600. So thinking that you have bearish bias towards an asset that is destined to go where we are now, it taught me not to have a bias eventually. So so that's another thing. No bias. The only bias is towards making money.
Yeah. So you really learned your trading habits and skills and system in the fire.
Yeah. It was amazing. Amazing place to learn. It was the floor of an exchange. We had 2 products. We had the knife futures, which no longer exist, but basically it was the New York Stock Exchange Composite Index. So every stock traded on the big board was the index. The other product was the CRB Index. So it was an index of all the major commodities that were traded. So you learned kind of both sides, the financial side and the commodity side of the business.
Yeah, you can sort of learn structure and technical analysis, but then they move slightly differently because they're composed of different actual components and businesses behind them. So there would be little differences.
Yeah, and that's there's lots of myths and oversimplifications in this business. So one of the myths is, oh, it doesn't matter what chart I'm looking at, if this is the pattern, but it really does matter what chart you're looking at. Commodities in general don't go negative. So the closer you get to zero, there's a huge incentive for consumers to start storing. So for producers to start storing as opposed to bringing product to market at a loss, and consumers to buy this, undervalued asset and pay for storage because you're so close to zero. That really doesn't, I don't think there's anything like that in equities or FX or the bond market. It just doesn't translate.
That's a good point, that there's a serious physical component to it that holds it up, that has to always be available. And I do think that even in the indices, there's differences. Like, I think that each market has a little bit of, I don't know, energy and to her, that she'll move a little bit differently. You can learn little tells that are different from one chart to the next.
Absolutely. Yeah. So and that is one side of it. The other side, to bring it back to like the risk management thing, is I tend from a risk perspective to look at equity indices as all like one basket of risk. So I'll have, and I wrote an article on this too. I call it the 3 tiers of risk management. So I'll have a per asset, and then let's say I set it at 200 basis points of risk. So if it's, $1 million in an account, I don't want to risk more than 20,000 on any trade, right? 2%.
Okay.
But I also look at the entire basket. So like Nasdaq futures, S&P, the Dow futures, the Russell 2000, and even like I trade the Nikkei 225s. I look at that as one basket of risk. So I'll have a higher setting for it. Usually if it's that correlated, around 3.5% of assets under management. And that way we have a crash or something, so they all crash together, and I don't want to lose more than 3.5%. It gets a little trickier when you get outside of obvious baskets. Like FX is another real obvious basket where they're all pretty much traded against the US dollar, the way I trade it. So I'll do the same thing, 3.5% there. Others, I give more leeway because they're somewhat correlated, but not really. So when you get into the grains, maybe I'll raise it up to around 4.5%. But the idea is these things are all kind of related, and you don't want to have too much exposure by fooling yourself into thinking that they're different assets.
And they do really move together, the things that you are speaking about, when they are correlated like that. If they're bullish, oftentimes they might be decoupled for a small period, but then they're generally going the same direction. So that makes so much sense that if they're falling, like, don't hold any of them. Diversification.
Absolutely, yeah.
Yeah. So you manage funds now, correct? Sounds like you're speaking from
what's called a startup CTA. And we've got a product which is called Return Alpha, another one called Tara, another entity that we have a partnership called Entropy. And so they have their own models, and I do the risk oversight and the adaptation of their models and implementation of their models for our markets, which are the futures markets.
Yeah. And do you find that you hedge futures and Forex trading, like with bonds and other like different moving assets in that situation, or?
So the different models have different regimens regarding hedging. So the Taro model does have a lot of hedging of positive correlation assets off of each other built into it. My model, I really count on the risk ceilings between positively correlated assets to act as a de facto protection and de facto hedge. Sometimes I end up with real hedges on, like we have one now where most currencies against the dollar are actually bullish and we're buying them, but the yen and the Canadian are bearish and we're selling them. So that ends up where we have a kind of de facto hedge.
Yeah. Just based on analysis and studying the industries and what they're doing on their trends currently.
Yeah.
That's active management.
The risk management's always really tight.
Okay, so how did you get from on the floor in 1987 to this beautiful, amazing work that is a little bit beyond me? I'm not going to lie. What did that look like for you? How did your journey progress through all of that learning?
It was all over the place. So I did not earn a living from trading on the floor, nor soon afterwards. So I went into education that enabled me to have access to the charts and enabled me to build up a stake and really learn how speculative trading works. And simultaneously, I started working with lots of commercial hedgers, risk managers, and doing all that work in the commodity industry. So mainly energy companies and also some agricultural firms.
Okay. That makes so much sense because that, for me, you are a true professional who's been in this game for a very long time, and seeing what you're doing now is impressive. But what you're saying right now just makes so much sense because you essentially had to learn. You had to like not make money, figure out that risk management was key, learn education, get exposure to the industries, and then you started to like build your system. It's like you go to med school, right? To learn how to be a doctor, you also have to be exposed to people and see it and experience it, touch it, and learn it to start building.
Yeah, I mean, that's the way it was for me. Yeah. So, and I definitely think that there's different stages of it. So, I did learn risk management pretty early on, but then I learned how to develop positive expectancy models and what they looked like and, what were the elements, what was good risk management, because it's very counterintuitive. I think I went from having no understanding of risk to having a really good understanding of risk, but then being risk averse. And I think a lot of professionals end up in that boat where they're like so good at risk management, they're not earning enough. And it doesn't justify all the work you put in.
Yeah.
And
Right.
then you have to get more aggressive. So there's this sweet spot, this middle ground where you're aggressive, you're willing to take, I don't know, I think for me, somewhere between 20 and 30% peak to valley drawdowns in equity in a really bad situation in order to make somewhere between 30 and, amazing, knock the cover off the ball type of year, 100% or slightly above, triple digit income. So that turned out to be my sweet spot, but it wasn't there in the beginning. I don't want to risk more than 10% of my money in a peak to valley drawdown. And I'm willing to have a 15%, or less on a yearly basis. And I found out, not only was that kind of sleepy for me as a trader, but investors weren't excited about it.
Wasn't enough return for the
Yeah,
risk.
not really,
Yeah. But it makes sense that you'd have to grow into that because that kind of leverage, I mean, even just for me as a futures trader, when I add another contract, it gets me a little, I got to be real careful and I might micromanage even still, like, so that leveraging up, you have to grow as a trader, I think, to be comfortable enough to even hold the position and to be able to hold it with enough courage to let it rise to those higher targets and not just want to lock in green. So it makes sense that it would take time, I suppose, to like grow into that.
Right. Now, in Trade Like a Casino, there is a chapter called regret minimization, which is a tool that I found really valuable. So the
Yeah.
idea is you put on, as long as you're not over leveraging risk wise, you put on two contracts, right? And then you take off half of it at your dream profit target. And then you allow, because you've already locked in a good profit, you trail with a stop on the remainder. Same thing with entry. Like I'll enter one contract at the market so that I never miss a trade. And then I'll have like this logical pullback level and I'll enter a contract there. And then I'll have a contract that I hold, it's like a couple of ticks away from the stop loss. Because if I've picked my stop well, it shouldn't hit it. If it does, it does. I lose an extra, couple of hundred. But it's almost like you have the ability to actually have a winning lottery ticket. Because if you lose, it's a couple of hundred. But if it doesn't hit your stop, it goes
Take a
all the
sense
way
never.
back and suddenly hits the target. Now you've got two contracts where you have a trailing stop and you have this monster trade on.
I love getting in on a pullback. You see an engulfing that's showing you the direction and then it's coming back. Like getting in up on the pullback there is like the best because sometimes it does, just like you're saying, it will wick to get the last remaining orders. Any stops it can grab, and then the move will continue on after it showed you some intention initially. So that's a beautiful thing. And scaling out makes so much sense because you lock in, you get to a really logical, smart target and you lock in green, and then you're in a guaranteed trade. Like that trade is green. So, I love that style so much.
Yeah. Now, it's really important that you get away from this myth, which is like it's a cliche, which is never add to a losing position. I agree with that in terms of breaking the risk management ceiling, which whatever, put it at whatever percent you're comfortable with, 1%, 2%. So I'm not saying I'm breaking the ceiling by adding a contract. I'm saying that I trade small in the beginning so that I can then add into the pullback and not break the ceiling.
Okay, I'm pretty sure you're like officially my new favorite expert because that makes so much sense to me because I have done that and it has worked for me more times than it has not. And then there is a discussion of dollar cost averaging and adding to a loser. But in my opinion, it's building your position in the area of interest. You get in case it does fly, but then if it's messing around in the area where you want to get your position built in, that's an opportunity to add as long as, like you said, you're honoring your system rules and your portfolio size, your account size, and you're not over leveraging. If you're just getting your full size built up as it's hesitating before the move takes off, for me that makes sense too, like systematically, because you're just building your position and you're managing your risk by intentionally still having a stop loss.
Absolutely. Yeah. I think that's what it is that people think when you say you're adding to your position that you are just gambling, doubling down on losers. And that's not what I'm doing. And it sounds to
Right.
me like you've discovered the same thing. And
I
yeah,
have. I
yeah,
think I didn't fully understand it in the beginning. And when you're still learning and figuring out your system, it can be a like, I don't want to lose and I have to be right. It can be from the wrong intention, I suppose. And that's what maybe some early traders do. But if you start to understand a little bit more and it's very intentional, I don't think it's gambling at all. I think it's like a system of getting into your desired trade.
absolutely. Yep. Yep. Yeah.
So
Because
trade like a casino. That sounds like a smart book.
yeah. So when I entered the business, I looked at it kind of like, what is the science of this thing? And people weren't able to tell me. I asked, and people were like, there is no science to this thing. You take shots. But as I learned what it really was, I discovered that there is a science, there is a model, and the model is the gaming industry. And people don't like to talk about it because people think that speculation is gambling. But if you think about what a casino does, right, they have probability skewed in their favor. And as traders, that's what our models are generating, right? They're generating positive expectancy, where through the combination of the percent winners and the size of the average profit vis-a-vis the size of the average loss, over a large sampling that you have positive expectancy. It makes money. Okay. And in the gaming industry, they call that the probability skew. It's the skew that the house has over the gambler. But even in the gaming industry, probability skew is not enough. If you have a player who's affluent enough, like a Bill Gates or an Elon Musk, they could theoretically walk into the casino with a cashier's check for $1 billion, turn it all into chips, and walk over to the roulette wheel and put it all on red. So yeah, you've got the zero, you've got the double zero. The probability is skewed in favor of the casino, but they can't take that bet because if the low probability event occurs, because you've allowed the player to bet too big, they now own the casino. So they instill table limits. Now, table limits is what in trading we call risk management. So if you think about it, probability skew and table limits, the casino now has a robust model that will keep them in business forever. And you don't hear of many casinos going out of business. What they also have built into that is that they know definitively that they can trust the numbers. We as traders need to believe that we can trust the model and the risk management criteria. And the way we build that trust, I would argue, is through backtesting. So you build, what you believe is a positive expectancy model, and you look at what happens if you risk 200 basis points and then run it over a series of uncorrelated assets over a large data set and see, does it actually work? If it does, and if you're managing the risk properly, you should have the same confidence that a casino has. And that's the psychology part.
That makes so much sense because you really like if you have a trade that has a high percentage win rate and then you have studied it and tested it, then the losses here and there shouldn't be phase you so much because your system is solid because of the experience, the way you've seen it play out on the charts, and knowing that, maybe this trade didn't win, but it doesn't mean it's not a good system and your system is solid. Because I think for me, I don't know about everyone else, but for I think is the issue of earlier traders is that a loss can be very stressful. Like what did I do wrong? How did I miss that? You could revenge or chase or FOMO after a red trade. I mean, after a winning trade, I feel comfortable walking away. I feel good. I'm happy about my system. But a red trade, there's potential triggers there that I'm getting much better at now in just muting those and recognizing, like you said, the probability stance of any part of trading. But I think that it's harder when you fear, when you fear that your system isn't good and you did something wrong and maybe you don't know how to trade, when there's reasonable expectation that not every trade is going to win because there's very few models that are 100% rate. I mean, if any.
Right. Yeah. And I've looked at lots of models, and I've looked at the trading records of other traders, including even Renaissance Technologies, which is like superstar level. Like James Simons, you can't get better than that. And even he, I believe, had a win rate of something like 65%. And profit to loss rate wasn't even that great. It's just they did so many tens of thousands of transactions that they were just doing amazing for decades.
Yeah.
Um, and so that's the big secret of this, is that there is no big secret. We're all just, we're in the mud, and we are just taking shots, managing risk, and keep plugging away at it.
What I really appreciate about having you on today and everything we've talked about so far is the fact that you can be an early trader and lose and not be sure and seek resources and take your time. But like, look what you've built. Like, look how you're able to speak of the markets and the models that you've designed and the way that you're managing money now. Like that long career for me, it sounds like, correct me if I'm wrong, it just is the result of like showing up and learning from different people and studying and backtesting and building and trialing and erroring and fine tuning. And then, I mean, I think anyone, if they're in their first, 0 to 5 years of trading, sometimes there's times where you're like, I'm never going to make money and I want to quit. But I would argue that persistence and just keeping at it and keeping learning through that phase is kind of the key to actually staying long in this game. Would you say?
Yeah, I think that you want to have a real respect for risk. That's going to keep you in the game during those early years where you're learning. And just remember that if you can stay in the game, then you are in the same boat as every successful trader, because every successful trader that I've met started out as an unsuccessful trader and just kept at it, while being humble, put it that way, and
Yeah.
respecting risk.
Yeah. I love that. And honestly, it makes me feel better as an earlier trader is that exactly every single trader who is a millionaire or whatever level now they are, they had their time where they were in the same boat where they are having losses and win days and celebrating and confused and scared. And yeah, I love the energy of like just keep showing up because then it's showing the universe and your system that you're not going anywhere. And so you might as well learn and refine and get better.
Yeah, and if you really look at it, we're all in the investment business, whether we recognize it or not. You have capital, and it is a finite resource, and you're going to put it to work somewhere. So giving up on trading, I mean, all right, if you have a reckless gambler's mentality, maybe
Maybe
putting
it's not for
money
you.
into T-bills, is the right thing to do. But for the rest of us, you're going to be in this business one way or another. Even if you stop actively trading, you're going to have your money in some type of, like SPX or, SPY or something like that. And so you're in the markets. So whether you like it or not, you're going to continue to operate in the markets and to learn from the markets.
Yeah. So like make the lessons count and just like try and keep building what you're going to do. And I think it's so validating to know that you can be a red trader for whatever period that needs to look like for you. I think everyone's journey is a little bit different. How old you are, what other commitments you have, how much money you need, if you have to have another job, if you have children, it will look different for different people. But to have good people around you that are teaching you a system and refining it, I think is one of the keys, like you said.
Absolutely.
What else did you do that really helped you? Did you have any other key lessons early on that were really impactful?
So I think one of the things that was really valuable to me was, and there's a chapter in the book on this, I recognized that basically, if I start with a concept, simple stuff like, what do I believe about market behavior? So I came up with two things, working backwards. And the first thing was that markets trend, not all the time, but, they do have this tendency to get into a part of the life cycle of a market where they are trending. And that portion of the cycle tends to generate good risk reward opportunities. And I mean, obviously this is going to become dated one day, but as of like October 6th, 2025, it's really obvious to everyone who's even just like glancing at the markets, what market's trending. I mean, would you be surprised if I told you that I think the Nasdaq is trending up? Right?
No.
It's obvious to
Yes.
everyone. So that's what I mean by trending.
Yeah.
Gold, silver, these are markets that are trending up. I don't think anyone can argue with it. So what is the argument? The argument becomes, oh, but I missed the safe part of the move. It's dangerous now. Oh yeah, it's a bubble. It's going to go down. So okay, that's fear, and fear is based upon the possibility of loss and danger. That's why we manage the risk. Okay, so this is a market that we agree is trending. Don't risk more than 2% on it. Figure out what that is, and then say, okay, so I'm brave enough. If gold and silver and the Nasdaq all go down, I'll lose 6%. But if those trends continue, who knows how much it can go? Maybe it goes another 18%. I don't know. And that's the beauty of this thing. So that was the first major concept that I came to. The next one is a little bit more esoteric, but it makes sense if you think about it. Okay, so we talked about this trending aspect of market behavior. And in statistics, you can think of it as like the fat tail in a distribution, right?
Okay.
Okay, so the opposite of that is when markets are kind of like an equilibrium. Everyone agrees what the value of the asset is. The value of crude oil is $61 a barrel. And it goes up from there to, let's say, 65, and it goes down to, let's say, 59. But, it's pretty much at fair value. So this concept is that everyone agrees what value is. And because there's consensus, it's very easy for any little piece of news to knock out what we believe fair value is. And everyone finds that the equilibrium point is no longer in balance, and you start trending right out of that low volatility consensus. So the idea is that low volatility and consensus of value is highly unstable. And therefore, any little bit of news is going to knock it off its quote unquote fair value. And we don't know if it's going up or down, but we definitely know that it's unstable, that stability and the agreement of value is an unstable state long term. It's not going to stay there. Once upon a time, gold was in low volatility and was stable, and everyone agreed that the value was whatever, $1,200 an ounce. Didn't stay there. Same thing with the Nasdaq. So this is the other side of the coin in terms of where I believe traders can find an edge is, low volatility breakouts from stable, low volatility environments.
Right. So the longer time something is basically consolidating and then you get a solid break out of it, there's could be a move there that you could get with.
Right. And it's the similar concept as the trending market. It's like, okay, so there's two possibilities. It's a real breakout or it's a false breakout. So if it's a false breakout, I'll lose 200 basis points. But if it's a real breakout, you know, it could be huge. And
Yeah.
so it's worth it to take that kind of a shot. And really, that's my entire career and all my positive expectancy models in a nutshell. They either do one of those two things.
Yeah. Follow the trend, or if they're consolidating, wait for the breakout.
Yep.
Yeah. Do you mess around in a consolidating chart, or do you just set alerts and look for something else? Like take little
So,
scalps or?
yeah, so I could, in theory, it depends on how close we are to. So there's short term consolidation, right? Which is the immediacy of a breakout from that consolidation. And then there's long term consolidation. So if it's in long term consolidation, so like think about the 50-day moving average and the 200, and they're really close to each other, then I probably would just play the breakout. But if we're in a short term consolidation, but longer term, according to the 50 and 200, they're really far from each other. It's obvious that this consolidation is in the context of a longer term pullback in a bull market or bear market. Then I would trade either with the breakout if it's in the direction of the trend or against the breakout because the long-term trend is still up.
Right. Because then even it's more like just a flag. Like it could just be a
Yeah,
flag created and then you want to catch the next leg.
right.
Yeah. Okay. Yeah. Thank you for sharing some of that strategy. That's really helpful to see kind of what you're looking for in general for your best trade, sounds like.
Yeah. Yeah. And the beauty of this stuff is maybe it's just me, but I think a lot of traders are incredibly paranoid. Like, oh, I can't tell you that. I can't tell you. My opinion is, as an educator, it's like I can give people these basic concepts and I could give it to 1,000 really good traders. They're going to come up with 1,000 different models. They're not going to do the same thing I'm doing. And so I feel like I could be generous. And this is what I have found through back testing that and real-time trading, that this actually works. Go ahead, experiment, find your niche within these big, within these big circles of positive expectancy.
Mm-hmm. So then, in what you just said, being that there's multiple ways to trade a market, fine tune it and get your entry and make your system unique to your own style and what have you. What do you think is the difference maker in successful traders and not successful traders? If we know about trading with a trend and getting in at a reasonable value area, I mean, would you think that there's a psychology element there, or how would you quantify like the difference in outcomes?
There's multiple ways of losing money. So let's go through them. I think the first most obvious one is failure to manage risk. And there's lots of iterations of it. There are people that, it's almost like, an addicted gambler where they swear they're never going to break that risk ceiling. But then they see a really good trade and they say, well, this is the opportunity of a lifetime. I'm just going to break it this one time and then I'm going to go back to my normal risk regimen. I think that's the number one way that people blow up accounts, is either never having a risk criteria in the beginning or having one and breaking it, just like an addicted gambler would, right?
Yeah.
Okay, so that's one way that people fail. The next way, I guess you could call it like system hopping. So they have a model and it works, and maybe even they have some success with it, and then it has a cold spell and they think that something's wrong with the model. And there's two possibilities. Maybe the model isn't that robust, or the markets have dramatically changed and what worked for them is not going to work for them, and they do need to hop to another system. But more likely, it's just having a normal cold streak and they need to stick with it and just ride it out. I think that's
Makes sense.
another common way that people who are well-intentioned get blown out in the markets.
chase squirrels almost, of like, I had this little losing streak, so I'm going to revamp and do this whole other thing. And it just kind of, I think it slows down your progress and kind of can derail people, get you off track of something that maybe just needed a little fine tuning, instead of just throwing it out with the bathwater and starting fresh. Then you're really kind of setting yourself back almost, because then you have to learn a whole nother system and potentially a whole nother mentor. Like that could be a year, depending on a lot of factors. But
Yeah, right. And then the most debilitating is when you system hop and then see that the old model would have had this huge win.
the
You know?
worst.
Yeah. So
Insult to injury.
yeah, so you're better off just sticking with what you know. And this is why when I'm teaching, I tell people start with these basic concepts. What do I believe about market behavior? And for me, I believe in the trending nature of markets. And I believe in the cyclical nature of volatility, that it's going to cycle from low vol to high vol back to low vol.
Can you
Uh,
explain that a little bit more? The
yeah. So
cyclical volatility?
you're going to go from this low vol consensus of value where markets are in a very tight range to high vol and trending. And then it's going to cycle back eventually to low vol again.
Yeah. Okay, I've seen that. Like you'll get a big move and then it will just give a bunch of dojis. Like it's like a breathing period almost. Like it
Yeah.
has to pause from all that crazy momentum. People are going to take profits. It's going to settle, and then there'll be another opportunity. Like
Yep.
that?
Yep. Just like that. Yeah.
Smart. Okay.
I do think those are the two most common ways that people derail themselves, is by system hopping and not respecting risk. I think that for most people, you also need to figure out what kind of trader you are and stick with it, and really understand what's entailed in that kind of trading. So like the easiest way to define what kind of trader you are, other than, I'm a trend trader, or I'm a counter trend trader, I'm a pullback trader, or whatever, is the duration. How long do you hold a trade? Right. Um,
Right.
and really understand what that lifestyle of trading is and be comfortable with it. And then develop a model that works for that style too. I've heard people say, like, it shouldn't matter what your comfort or lifestyle is, only this works. But I think that you have to be a little bit flexible. You can't demand that someone be a day trader if their personality is to long-term position trading.
Yeah. Because if you're going against who you are and what you're most comfortable with, it's going to be an uphill battle, and you're going to make some choices that are not as ideal because you're not looking at it fully objectively and openly and like wanting to be a part of it. I think if you're going against who you are, you have to be comfortable, right? I think you have to be comfortable and it has to speak to you in order to execute most confidently, but not ego driven. Like to really settle into your system, it has to be kind of in tune with who you are. That makes
Yeah.
sense.
Yeah, I do think that as well. Yeah, you know, it's tricky because I've heard heads of trading desks say, if you're going to trade here, you're going to trade this way. But I think that we need flexibility. I think it makes a desk more robust if you have different types of traders with different time frames of trading and different levels of expertise. And you can kind of, you can diversify the desk if you think about it that way.
So I don't think I mentioned, but that Trade Like a Casino book, actually, you are the author, correct? And it's one of two books, right? That you wrote?
Yeah, so you can see them both back there. There's Trade Like a Casino, and then my first book was Mechanical Trading Systems. I do feel like Trade Like a Casino was my definitive statement on trading. Mechanical Trading Systems is a good book, and I'm glad I wrote it, but I do feel like the publisher I was a first-time author, and they kind of pushed me to finish it
Oh,
fast, and I didn't have the time to do it the way I wanted to do it, which ended up being Trade Like a Casino, the second book.
perfect. But then, you had more time to refine and realize what that was kind of annoying with the first book and then pull it all together. And that's amazing. I definitely need to read that book. I'm excited.
Yeah, well, thanks. Yeah, I was really happy with it, and it's gotten positive feedback. So it's
Yeah.
funny because it's not like it reinvented the wheel or stated stuff that people didn't intuitively know. It's just it stated out loud and in writing what I think traders, successful traders, all intuitively realize that we are trying to develop that casino paradigm.
Nice. And I think that as traders, like, I don't know that it's the same as this in all industries, but I think in trading it's heavier than most, because I think for me, especially, I've had to hear something strong advice multiple times before it sunk in deep enough to change the way I execute. Because if I, heaven forbid, started with a bad habit or a bias or something in my trading career, and I've needed to refine that, it's nothing, none of my growth has ever been like, okay, my mentor told me to never ever do this, and so then that was it. I never ever did that once again. It's almost like it takes time, I think, to rewire the brain and turn the bad habits into healthier choices. And so hearing things repetitively, I think, drives the message home deeper. And so that's why, I mean, I've consumed a lot of trading books, and I watch different podcasts, such as this episode, maybe for people, because I think hearing the wise words and education of people who understand a little bit more than us helps the messages sink in deeper, in my opinion.
Right. Absolutely. Yeah. And, to always be learning. I think that's the thing, is that I'm always trying to get better at what I'm doing and look at ways of incorporating different tools, different techniques. I think that
Smart.
that's part of the journey of a trader, and what makes you successful and what keeps you sharp is
Right.
always the ability to look at it slightly different, and, without getting too crazy about it, but to kind of like, what can I do to fight for another 3 ticks? I'm not saying you do that on every trade, but as a philosophy, instead of making 18.35 on the year, what could I do to get it to 18.65, which is a very small difference. But if there are minor things I can do in execution without sacrificing the integrity of the system, then why not gain another 30 basis points of capital every year?
Yeah. Richard, I love that. It's like the constant, like, knowing that you want to get a little bit better and pushing yourself and having the courage to say, but if I do just a slight adjustment, can I do better? I think that's what probably why you're in the position you're in, of being able to manage like a bigger firm, because you have to be able to push yourself and continually hunt for refinements instead of being complacent. And that opens up so much more opportunity to expand moving forward, because you're not just settling like, I have a 60% win rate, and so if I just do this, I'm fine. But instead, like, how can I add a contract and then aim for the 65% or whatever? I absolutely love that energy.
Yeah, yeah. And I think it just helps in terms of like pushing myself just a little bit in order to stay sharp, because this is a
Yeah.
business where it's very easy to become complacent. And complacency, it's very easy to go from complacency to backwards and backsliding. It's imperceptible, but can happen.
Yeah, because there's almost an energy behind that. It's like not pursuing, holding your own, getting better, fine tuning, instead just settling. You almost probably in that role. I mean, that's not me, but in that situation, you might be like not as observant and not as interested in slight changes in market condition. You might not catch things as soon. So I'm definitely more of the continuous learner and curious about what the market can tell me over the alternative of that too.
Absolutely. Great.
Mhm. Yeah. Any tips you would have given to your former self earlier in your career that you wish you had known sooner?
I think the look for the casino paradigm, get big concepts, look for asymmetry in terms of risk and reward, look for opportunities where I can risk a little in order to make a lot, because they do exist. And then try and build models based upon those types of opportunities. I think that that is a key thing that most people either don't believe is out there or think is not repeatable. And in fact,
Yeah,
markets are
it's a
very
unicorn.
inefficient.
Yeah, yeah. People think that sometimes that's like a unicorn, like the GME squeeze will never happen again. But maybe just this random thing won't. But you can, I think, like you're saying, like find repeatable patterns in different situations, different setups, different timeframes potentially. But you'll see similar things that you'll recognize sooner if you watch for them and you see them multiple times. You start to recognize them sooner.
Right. Right.
Yeah.
And yeah, and I think that low volatility is one of those things that you'll always have. People think that it's not repeatable, right? Oh, this is not going to happen again, but it always happens.
Every day.
Yeah, yeah. So it's
Yeah.
there. And just the funny thing was, I was looking at someone's post on LinkedIn and they said, oh, and these are the best times to trade the market and these are the worst times. And I said, so could you also state that trading the market during lunch hours is terrible for trend following, but really good for mean reversion trading, right? So in
Yeah.
other words, just the ability to kind of look at it from a different angle and not be tied into, I
Black and
only
white.
do this.
Yeah. Being curious and open to receive what potential could be in front of you and not so black and white.
Yeah.
Yeah. Any psychological tips that we could help stabilize us?
There's a certain way of thinking about losses, which is to just look at it like part of the game. You're playing this game of trading. And in order to see the cards, to see where the market's going to go and participate in that movement, you've got to be willing to sacrifice the ante. So don't worry about losing the ante. You had to lose the ante in order to see the rest of the cards.
Yeah. That's a great perspective. Like, accept the risk fully because you're in a game of risk.
Yes. Yeah. And the alternative is not being in the game. And that's having someone else manage your money, right? So
Yeah.
yeah. So
Traders have to put on risk.
yeah, and I've always believed that I wanted to learn so that I could manage my money intelligently.
Nice. Yeah, that's really smart. Taking the stance of like owning your situation and then however far you can take it is kind of on you too, and that energy of like, oh, you want all these figures of all these people with all this wealth that you're seeing out in social media or whatever, like that doesn't magically happen. You have to show up for the work of that and build it based on what you've learned and refined and studied and executed and lost and figured out how to win. I think it puts it into perspective of like, if you want all these grand things, it comes down to like work and time and effort.
Yeah, it is. It is really a job just like other jobs in many respects. You have to be willing to put in the time, to be humble, to do the research, and to keep putting yourself out there. The only difference is most other jobs, the harder you work, the more money you make. In this job, it's not necessarily the harder and the longer hours. Instead, it's all about it's not as much about IQ, although you have to have a decent IQ. It's about EQ. The more emotionally resilient you are in the face of adverse conditions, the better your performance.
I love that. Yeah, having that emotional maturity in order to just weather the logistics of the game and stay cool and stay calm and be able to focus for the next best opportunity, even after a loss, is really powerful.
Yeah. You were talking about psychological tips. I think this is a tricky one, but I think that we all have this negative self talk, or most of us have this negative self talk inside of us. We've got to let it go. Best way to let it go is positive self talk. I'm not my trades. I take trades, and I believe that my research is sound, and I will continue to play the probabilities and manage the risk. Positive self talk.
Okay, I absolutely love that you said that because you are a mature man in the financial industry who is like self-talk is key. I think it's so powerful for us to be able to have like the humility but also the confidence and the courage in order to keep doing this thing and keep staying at it and believe that you are safe and happy even on the losing days and that your system does have support behind it and to like hold steady and still be like have faith in yourself and confidence to keep growing. I think that if we can rewrite the script in our head to be on our side, on our team, it's like, it's a game changer. For me, I think my personal development has been like controlling my inner dialogue so that I do feel calm and positive and open to receive and study and believe in myself. And I think that that has been the big change for when I went from unprofitable to profitable was basically just calming the hell down and shutting out that negativity. So I'm so glad that you said that.
Yeah. And, also like long game mentality that you recognize, you begin to see enough data points to understand 10 years from now, I'm still going to have losing days. It's not going to be like there's a banishment and they don't happen anymore. So I've got to learn how to be comfortable and happy despite losing days.
Yeah, because I mean, we have this life right now, and if a losing trade is going to wreck your day or your week, like that's not the best life that you could be living. You know, if you could leave that trade in a box where it is, journal about it, talk about it, learn from it, and then go out and have a lovely dinner with your favorite person and still enjoy the second half of your day. I think that is such a better way to like live life and to experience this journey as a growing trader too.
Absolutely. Yeah. And I like what you said about journaling. I journal, I keep an Excel spreadsheet of all my trades, and then I actually write down in words why I'm taking trades. I'll put a chart into this Word document, and this is what it looked like. And then I'll actually go back and see, oh, you know what? This wasn't that good of a setup. This was wrong. I didn't see it, but I see it now.
Yes.
Yeah.
Yes, I think there's so much power in that too, of like studying your own data. Like I thought this was this setup that I've studied and it failed. So why did it fail? And what was this day actually slightly different? Was the setup not quite there and I jumped the gun? Like I think we can learn a lot from our own personal data, which is a big superpower of journaling.
Emotional survival mechanism says, this was painful. I want to put it behind me. And so it's really valuable to say, okay, I know that's how I feel, but can I learn something from this? Let me actually look at it, even if it's a little painful.
Yeah, I absolutely agree. I think burying losses is just going to increase the likelihood that they're going to happen again versus just admitting them. You don't have to tell the whole world if that's not your situation, but tell one or two people if you have a close trading partner or whatever. And at a minimum, journal it out and look at it a little bit deeper to try and understand it. So ideally, you could not do it again I completely agree.
Yep.
Okay, well, you have dropped so many gems today, and I absolutely have learned, and I'm going to continue to dive in because I know a little bit about the casino paradigm, but I think that there's so much. The more we can understand about the bigger picture of trading and how all the pieces work together and how it can shape our whole trading system, I think that makes you just so much more of a powerful trader, having that global view that helps guide the individual trades. And so I think that is such an important thing to also make sure we're studying.
Great. Well, I'm glad that that you invited me on, Becky. I really appreciate it.
Yeah. Yeah, I'm really glad that you said yes and you're here today. And we're going to put some details if people can find you in the links below. Is that okay? What's the best?
Absolutely.
Okay.
Yeah, so you could email me, richard@weissmanconsulting.com.
Okay.
And that'll get to me.
Awesome. Yeah, that'll be a link. You guys can just grab it and find Richard and get more information from him and pursue relationships beyond. Because I think it's clear that you have definitely been in the game and gained a lot of wisdom in your experience and your time here. So thank you for sharing it with us today.
Thank you, Becky.
Yeah. All right. Take care, everyone. Happy trading. And thanks for being here at Market Mamas. Bye.